This is Business Weekend with Ross Greenwood.
Hi there and welcome to Business Weekend. I'm Ross Greenwood. It's great to have your company today. Coming up on the program, despite the lofty aspirations of this week's Economic and Productivity Roundtable, the sober truth is that Australia has lost competitiveness. Last week we told you Chevron Energy won't expand in Australia anymore in the future. This week, more multinational companies told us the same story, not the least of those, Mike Henry, Chief Executive of the world's biggest mining company, BHP.
Australia is an export-dependent nation, and as such, we have to be able to compete globally.
Another with a similar story is Meg O'Neill, Chief Executive of Woodside, Australia's biggest oil and gas company. Like we heard from Chevron Chief Executive Mike Wirth last week, she says justifying investment in Australia is just becoming harder.
So the last $30 billion US in material investments we've made have been elsewhere. And it's a shame.
And inside the government's roundtable this week was the former chair of the competition watchdog, the ACCC, Rod Sims.
Whether it's an approval or a rejection, just do it quickly. That's the point. I mean, we're not saying wave everything through. We're just saying do it efficiently.
Now, one of the tangible changes to come out of the roundtable is a road user charge for owners of electric and hybrid vehicles. But sales of EVs in Australia have slumped hard this year. So we speak with the Chief Executive of Polestar in Australia. That's coming up. But look, let's start with the roundtable. The aspirations were high. The immediate conclusions, to my mind, well, they're modest. What's being floated? More tax on high balance super funds? Well, that's not enough alone to improve productivity or to drive more economic growth. But productivity and fixing economic settings so the economy does move faster has to be tackled one project at a time. But what is blatantly clear is this: Australia is uncompetitive in global terms. In tax, other countries have cut taxes for individuals and companies. We're uncompetitive in industrial relations and wages, where the government's industry-wide bargaining has clearly made the nation less competitive. We're uncompetitive in the speed it takes to approve and construct new projects. And we're uncompetitive in energy prices. In fact, we're not even in the same ballpark as the United States. And don't believe me on this. Listen to the Chief Executive of Australia's biggest steelmaker, Mark Vassella from BlueScope Steel, which has plants in Australia and in America.
Right now, energy costs in Australia are 3 to 4 times more expensive than they are in North America.
Now, in this August profit reporting season, the warning signs are everywhere for the government. Australia's biggest companies are either moving their capital overseas or already have made the decision, because Australia is uncompetitive and too slow to say yes to new projects.
We've got to make sure that we are running the business as well as we possibly can, and that means thinking very carefully about where do we invest in the world to get the best returns and to deliver on our product.
We're not looking at anything in the East Coast. In fact, our plans for the foreseeable future would not include expansion of our facilities in Western Australia either. We've got backfill fields that will develop over time. But given the global competitive dynamics that we talked about earlier, there are likely other places where you're going to see more trains added before we would add them in Western Australia or on the East Coast.
Now, this should completely shock our whole government, our whole community, to its bootstraps. If our biggest companies and investors are turning their backs on Australia, the economic growth needed to pay for our first world healthcare, childcare, aged care, the NDIS and tax cuts just walks out the door with them. Just ask the former chairman of the Productivity Commission, Gary Banks, at this week's Alternative Roundtable that was organised by Senator Matt Canavan.
And the government's productivity agenda is mainly a spending agenda, and indeed you could say a spending more agenda. It's not one that involves, or has to date anyway, the kind of regulatory reforms that are needed. Now, energy and labour markets, two areas of crucial importance to Australia's economic performance, have been particular casualties of so-called reform.
If we continue along this trajectory, Paul Keating's Banana Republic prophecy will be realised, and far sooner than we think.
Banana Republic, you hear that? But the image that really should have shocked the Prime Minister and the Treasurer to their very cause this week is this one. Donald Trump in the Oval Office with the chief executives of Australia's two biggest mining companies, BHP's Mike Henry and Rio Tinto's Jakob Stausholm. All of them together pushing for the development of what could be America's biggest copper project, Resolution, in Arizona. Imagine this, our biggest companies being courted by the US president to spend their money in America in preference to doing it right here in Australia. Well, this week I did speak with BHP's Mike Henry, and I just asked him the background of that meeting with Trump, a meeting that so far, remember, has eluded our Prime Minister.
Well, so together with my counterpart at Rio, we were in there really expressing our commitment to progressing the Resolution project. And this is one of the biggest undeveloped copper deposits in the US. And of course, copper is a critically important commodity for every walk of life. So the U.S. government, with the support of President Trump and Secretary Burgum, is really focused on getting mining up and going and processing going in the U.S. And their support for the mining sector and for this project specifically has been very much appreciated. And we wanted to ensure that they understand just how committed ourselves and Rio are to continuing to progress this project.
But clearly the President did want to see, though, to send a message out, because this particular project, it's been contentious with local Apache groups and with environmental groups. So the President was obviously sending a message out to some of those groups and probably the US courts as well, do you think?
Look, I think what we're seeing here is a very fundamental support for reindustrialization of the U.S. and for getting mining and critical mineral supply chains more secure by producing more of them here in the U.S. And of course, that aligns very well with this project, albeit this project was something that we've been looking or trying to progress this project now for well on 20 years, or near on 20 years. It's been held up along the way in terms of some of the permitting that needs to be put in place. We're almost there. In fact, we were expecting a key component of that called the land exchange to happen this week, but that was delayed by a little bit. But we're keen to progress, and the U.S. administration is also very supportive of mining more broadly and of this project.
But it wasn't the only bit of government business that BHP did this week. It was also a part of the Australian government's economic roundtable. Broadly, what did the company tell the Prime Minister, the Treasurer, that group of people?
So because this is earnings week, I haven't been able to participate directly. I was afforded the opportunity to engage in advance. And our message here, Ross, has been very consistent and over many years, not just in recent months. Number one, very welcome focus on the part of the federal government on productivity and economic reform more broadly to make Australia more competitive. Australia is an export-dependent nation, and as such, we have to be able to compete globally. Now, right now, we've got in Australia tax rates at the top end of the OECD. Labor productivity has been stalled now for the past decade. Permitting takes too long in Australia, and energy costs are 2 or 3 times what they are in Canada, China, Indonesia, and elsewhere, and maybe double what they are in the U.S. That doesn't help us or any other manufacturing industry in Australia compete globally. And so hopefully the reforms that come out the other end of the roundtable are geared towards ensuring that Australia is more competitive, and that we can secure global capital to come in and invest in Australia to ensure that the strong Australia that we have today continues to be strong and is even stronger in future.
Now, I've argued for a long time that really this roundtable should have been called a competitiveness roundtable rather than a productivity roundtable. What does Australia lose from a lack of competitiveness that you described there?
So it loses opportunity to foster new industries in Australia, of course. And one of our concerns, and that we've been speaking about for a few years now, is that over the next 20 or 30 years, there's some economic headwinds coming Australia's way. As the commodity or the mix of commodities that the world needs most continues to shift, that's going to have an impact on Australian exports. And we all need to lean in together to try to stimulate new industries, new investment opportunities and resources, but in different commodities. But we have to be able to do so in competition with other countries around the world. And one of the things that we're seeing play out currently, including here in the U.S., is that there's many countries around the world that are moving aggressively to get business going, to make their economies more attractive, to try to bring in global capital, to get investment going quickly. And in Australia, we have to, at minimum, keep pace with that, because if we don't and we get behind the curve, then what we're going to find is that we won't be able to offset these economic headwinds, and every Australian will be poorer for that.
So in the past week, I've also spoken with Mike Worth from Chevron and with Meg O'Neill from Woodside, with Mark Vasella from BlueScope, and a number of other people as well. They're global companies that are telling me that because of energy prices, because of taxes, because of industrial relations, because of the speed of decision making of the Australian government, plus the return and the ability to get that return more quickly in other parts of the world, the US notably, it makes them allocate more capital there than to Australia. Is that the BHP experience as well?
Look, I think this is the reality that we're dealing with. And I'll use one example here. We have a large copper expansion opportunity that you'd be aware of in South Australia. And the South Australian state government has been very supportive and is working together with us to try to make sure that that investment happens. And this could lead to a doubling of production from our copper South Australia basin now. But for that to happen, and this is a really big capital investment, so huge opportunity in terms of the wealth that can generate for Australia, the jobs that it will create, but we're going to be competing against the building of smelters elsewhere that happens much more quickly, much more cheaply, where energy costs, and smelting is an energy-intensive industry, are lower elsewhere. And so we're doing everything we can to make sure that we can refine those plans to make sure that we're able to build something as cost competitively as possible to get it done quickly. But we are then reliant upon a forward view as to what's going to be happening with energy costs. Will energy be reliable? Will it be low cost? And of course, the economic settings in Australia are going to have a big bearing on the project economics, both in terms of the cost to get it built, as well as the ongoing fiscal burden that the project carries. And that's something that we've been clear with both state and federal governments about. But this is an opportunity that we want to make happen, and we're doing everything we can to make the case to both state and federal governments as to the policy settings that we think need to be in place to stimulate this sort of investment and other similar investments.
You know, I spoke to the South Australian Premier Peter Malinauskas a couple of weeks ago about this, and to me, he gets it. He gets the competition thing. He gets the energy costs. But you've got competing assets in Canada for copper. We've already talked about Resolution in the United States. You've got Chilean assets as well. So the point is, if you don't go ahead with the expansion of Olympic Dam in South Australia, will it make a material difference to BHP itself?
Well, of course, every opportunity is an opportunity that we wish to pursue. But there is competition for capital, and that's both within BHP, but also between enterprises. And so the opportunity at Olympic Dam, or Copper South Australia as we call that basin, is competing for capital with other opportunities in the BHP portfolio. And even if they weren't inside the BHP portfolio, the project has to be economic. It has to stand up against other copper supply opportunities around the world. And the Premier in South Australia really does get that. And like I said, the state government there has been very supportive of this project and business more broadly.
So can I go to iron ore now? Because here there's competition as well. There's more production from Vale in Brazil. There's similar news that's going to come online out of Africa. There's also increasing use of scrap. There's the maturing of China's demand as its infrastructure projects are rolling out. So there's a lot of estimates saying iron ore prices must fall from here. I just wonder whether this is a wake-up call, not just for BHP shareholders, but also for the Australian government that's relied on that iron ore price and demand being strong for a long time now.
Ross, this is such a critically important point. I mentioned earlier the economic headwinds that the nation is going to face in the coming years. One of them is lower future iron ore prices than we enjoy today. This is one of the key reasons that BHP has worked so very hard to get to the very bottom end of the cost curve and to run an ever more reliable business, because we know that the competition in this market is going to heat up, and we want to make sure that we're fighting fit. We've done that through an internal focus on productivity, becoming ever better every day. That's what we need to see across the nation, because as we see falling iron ore prices, less government revenue as a result of that business, we need to be generating new opportunities, either new industries or new resources investments in other commodities. Unfortunately, in other commodities, we don't enjoy quite the same geological or geographic advantage that we enjoyed in iron ore, and therefore it's even more incumbent on us collectively, government, business, and others, to be as absolutely competitive relative to others around the world.
And you also flagged the sale of some of BHP's loss-making Queensland coal mines, which were for decades considered some of the finest metallurgical coal mines in the world, and they were a mainstay of BHP's earnings. But you also said that there was an effective 67% tax rate with Queensland royalties included. So ultimately, what went wrong? Was it the royalties alone?
Well, so what we announced with results, or what I said during results, Ross, is that we've got relatively low coal prices currently. And in the face of that, there will be certain parts of certain coal mines that we have in Queensland that aren't generating a margin. And it used to be when you would take some of the downside in the hopes of being able to capitalize on the upside when prices rose again. With the new royalty scheme that was put in place in Queensland, they've essentially taken a good part of that upside. And so what you get left with is the downside. And as a business, of course, we need to be focused on stemming those losses as quickly as possible when they arise. And if we saw certain parts of our mines up there that were losing money, we'll have to move quickly, including looking at shutting in that production, at least for a period of time. And yes, the royalty regime in Queensland has made a big difference here. It's made Queensland unattractive for investment because of both the risk and the costs in our sector. And then in terms of the way that we operate our business, it's changed the economics of these operations and may lead to different decision making and decisions that see quicker action in terms of curtailing production when certain parts of that production are loss making. And of course, that unfortunately then has flow on impacts in terms of local businesses and jobs and so on.
And just a final one for you. This week you also said BHP in future will lift the amount of debt it carries from $5 to $15 billion that's currently to between $10 and $20 billion US. What I wonder is whether this is BHP management trying to juice up the share price growth at the expense of future dividends.
No, not at all, Ross. In fact, we have a sacrosanct 50% minimum payout ratio. This period we paid out at 60%. But what we're seeking to do here is well, number one, we review this net debt range on a regular basis, and it's of course there's judgment exercised in it, but it is financially and analytically driven. And given the nature of our portfolio, our growing position in copper in Chile, for example, soon to have a large position in potash in Canada, that's giving us greater resilience and therefore more ability to carry a slightly higher debt level, which is still conservative by industry standards. And through doing that, we're going to be able to invest in more of these growth projects that we have in Canada, Chile, US, Argentina, and I really do hope in Australia as well, because that's what will underpin future earnings growth or dividend growth for shareholders.
Mike Henry, it's always good to catch up with you. I appreciate your time today.
Thank you.
And Mike Henry is not the only Australian CEO being courted by Donald Trump. Here's another photograph from May this year. And there's quite a few people in this photograph. Donald Trump is at the very front, but in the back corner is Meg O'Neill, chief executive of our largest oil and gas company, Woodside. Now, the group is there as part of Saudi's oil giant Aramco when it committed a $300 billion US investment into America. And also as Aramco and Woodside agreed to explore global opportunities. As we've told you before, O'Neill is feted by Mexico's president when she visits that country, but that's something she rarely experiences when she visits Canberra. But late this week, there was a glimmer of hope. Woodside received the final environmental approval it needs to commission and operate a floating structure at its giant Scarborough gas field in WA. Hope springs eternal. I spoke with Meg O'Neill just after Woodside announced its half-year earnings this week, and part of this also is about where Woodside will invest in the future.
First and foremost, we've got to tackle energy supply and keeping energy affordable. So if you ask yourself, how have we gotten to the lifestyle and the prosperity that many Australians enjoy today? It is on the back of cheap energy. This nation was built with cheap coal and cheap natural gas. And increasingly, we are putting barriers in the way to continue developing our natural resources. Now, I fully accept that we need to be taking action to address emissions and to respond to climate change and to be particularly looking to move away from some of the emissions-intensive coal-fired power gen that we've had in the past. And so renewables are going to be part of that mix. But to keep reliable power that will enable industry to continue, to enable investment in critical mineral processing, to enable investment in data centers and AI. All of these things that will unlock future productivity, we've got to have affordable energy.
And should we assume that all of that energy is in Australia and that it will be developed in Australia?
Well, look, there's plenty of gas. There's no doubt or debate about that. There's gas in Australia. There's gas that's been discovered that's waiting to be developed. And, I'm an optimist. I suspect there's plenty of gas that's waiting to be discovered as well. The challenge is, can we get it developed or not?
So there's the big issue. Getting it developed right now. You're stuck after waiting 6 years for environmental approvals for the 40-year extension of the North West Shelf. And then the Environment Minister, when the new Parliament was created, said, right, we're going to do this straight away. You're still waiting. Why are you still waiting?
Yeah, and look, I think it's a great example, and I hope the Productivity Roundtable is talking about this as a poster child of why we need regulatory reform. So first off, you have to ask yourself, why do I need a state approval and a federal approval for basically the same thing? Secondly, if you do sort of accept that maybe you do, why can't it be run concurrently? And look, on the specifics of Northwest Shelf, kudos to Minister Watt. One of the first decisions he took as Environment Minister was to give us a preliminary decision approving the extension. The WA state government took 6 years of very rigorous analysis to give us an approval with really robust conditions. The robust conditions are based in science, and they're technically feasible. And that's the same outcome we want from the federal government. And, we're frustrated. We've been trying to negotiate conditions that meet those criteria.
What's the sticking point?
Well, scientific and technically feasible. So that's the outcome we want. We need to make sure that whatever conditions are imposed align with the science that's been done to understand impact of emissions on rock art, and that it's technically feasible.
I was going to say, it is partly about the rock art on the Barra Peninsula.
It is all about
It is all about that, and
Correct.
about what your plants do to that rock art over time. Is that pretty much it?
Correct.
Yeah.
And look, kudos to the WA state government for implementing a rock art monitoring program using independent scientists, working closely with traditional custodians to gather data, analyze that data. And the report that was issued just a few months ago said, look, there's no sign that emissions from our facilities are negatively affecting rock art. So that's good. We know we need to be proactive, though, in tackling emissions that maybe would have an impact. And that's what we've agreed to with the state. So we just want really the same thing from the feds.
Okay, so one of your counterparts, Mike Wirth from Chevron, the Chief Executive Chair of Chevron Energy, the biggest oil and gas company in America, told me last week that he will not, on behalf of Chevron, invest another single dollar in Australia because he has other options in other parts of the world. Do you have those same options as well?
Well, look at our track record, Ross. So the last $30 billion US in material investments we've made have been elsewhere. And it's a shame. I mean, it's really a lost opportunity.
Could have you made those investments in Australia?
Absolutely. So the Browse opportunity, very significant gas field. It wouldn't have used all $30 billion. It would have used a chunk of it. Very significant gas resource. The environmental applications to get that approved were also submitted in 2018. So, 7 years in, and we still don't have a line of sight to getting those approvals.
So you've got Trion in what was the Gulf of Mexico, now the Gulf of America.
Oh, no, it's on the Mexico side.
On the Mexico side, still the Gulf of Mexico. All right.
Yeah.
You've got the Louisiana LNG plant. How much do you spend on that?
$16.5 billion. 17 billion.
17 billion US, right? So that's, again, then you've got...
Beaumont New Ammonia.
That you do, and then you've got Senegal.
Correct.
So you are now diversifying around the world outside of Australia.
Yes, we are. And look, from a business perspective, that's a good thing for the company. It gives us geographic diversification. The Louisiana LNG investment, I think, will be fantastic for us to be a global LNG powerhouse and to be able to operate in both basins and, meet customer needs wherever those needs arise. So from a business perspective, it's fantastic. Australia needs to be asking about lost opportunity.
Do you think that Australian politicians take Australia's natural resources for granted and presume that the development and the projects will always be there?
I fear that may be the case. Yes. And look, we do have big investments here. The Scarborough Energy Project, we're building another LNG train at the Pluto site, developing a very large gas field off WA. So investments are continuing, and Look, I do worry that there's a bit of complacency, that it's always happened, so it will continue. But again, the barriers, and I think Mike Worth spoke about this as well, approval timelines, changing regulations, PRT, so the tax rules changed after people had made investment decisions, safeguard mechanism, we've got clarity for a period, but what's going to happen in the next phase of government? There's just all these things where the burden is adding up on the oil and gas sector particularly, making it more difficult to invest here.
And then there's the East Coast crisis of gas. Do you see that being fixed anytime soon, and can Woodside play a part in that?
Well, look, we are playing a part. So we have a 50% interest in the Bass Strait joint venture. So these are the big fields offshore the coast of Victoria.
And you've taken control of that from
Well, we will
Exxon.
in 2026.
Yeah, that's right.
So super excited. We'll come in and we'll take over operatorship.
Is there more gas in Bass Strait?
There is more gas in Bass Strait.
Will you find it?
Well, it's already been found. So that's what's exciting. That's
where you started, of course, Woodside.
Yeah.
And you didn't find the gas. That's why you went to the Northwest Shelf.
No, we struck out in Victoria, so we went up north.
But now you're back there.
It's a bit of a homecoming for us, so we're coming back to Victoria. There is more gas there. One of the things we negotiated with ExxonMobil is the ability to develop some discovered gas resources 100%. So Woodside pays all the money, but we get all the revenue. So we're excited about that. It's about 200 petajoules of gas that potentially could be developed. And
is that enough to take pressure off the East Coast gas crisis as it sits now?
Look, it helps, right? It helps. But operatorship transfer will be complete next year, and then we have to have a bit of time to complete the technical work and to do the drilling and bring the wells on. So it's not going to help with the 26 problem or a 27 problem. And at the end of the day, it's a small quantity when you look at the magnitude of the gas market.
Okay, so what else would help that East Coast market? Presumably finding more gas.
Well, finding more gas, right? I mean, finding more gas is the starting point.
Is it there, do you sense? The gas, is it there?
Oh, yeah. Yeah. Look, our view is there is gas, but we've had a decade plus of policies, particularly from states that are big gas users, that make it somewhere between difficult and impossible to develop gas resources. Now, pleased to see the Victorian government has made some kind of cautious changes to facilitate or support more gas. But at the end of the day, we need to, have a little bit stronger signal, both at state and Commonwealth levels, saying we need more gas, and we're going to help tackle the red and green tape that is making it difficult to develop gas in this nation.
Okay, final one for you. The truth is, though, Australia might have lots of gas, but it's not the only place in the world that has gas. That's the real message for politicians.
Well, look, when we ask ourselves where can we invest as a company that wants to invest in energy, and we think LNG has an incredibly important role to play, regardless of how fast the world chooses to decarbonize, you ask yourself, where's their gas? Okay, Middle East, Russia, those are not places that are good fits for Woodside. North America. North America has a ton of gas, and if you look at the data, 15 years ago, people were saying the U.S. was going to have to import gas. Now it is the world's biggest gas exporter. And that's technology, that's innovation, that's entrepreneurship. And at the end of the day, it's the capital market doing what it needs to do with a regulatory framework that allows it to get on with business.
One last quick one. Should Santos be owned by the Abu Dhabi government?
Look, that's a question for the Australian government to answer. We wish all parties well.
Well, Woodside was, of course, protected by a treasurer from a takeover by Shell. The question is whether foreign nationals should own our big oil and gas companies.
Again, that's a question for the Australian government. We're very focused on taking care of our business and doing our best for Woodside shareholders.
You ducked that one pretty well, Meg O'Neill. Thanks for your time.
Thanks, Ross.
Coming up after the break, we break down Australia's lack of economic competitiveness with the former chair of our competition watchdog, the ACCC. Rod Sims headed the government's roundtable session this week on improving our nation's competition. Thanks for being with us here on Business Weekend. Well, today we've spent a lot of time talking about Australia's competitiveness or lack therein. You've heard from some of the most senior business leaders in Australia saying they'll direct more capital in the future overseas rather than here. Economic competitiveness was on the table for discussion on day 3 of the Economic Roundtable, and the discussion was led by the former chair of the ACCC, the Australian Competition and Consumer Commission, Rod Sims, now co-founder of the Superpower Institute, which seeks opportunities in a post-carbon economy. And I spoke with Rod Sims just a little earlier.
No, it's very accurate, Ross, and I talk to companies all the time, and they're extremely frustrated. I think it's got a lot to do with inappropriate regulation, different regulation between states, and very slow application of the regulations we've got. All of that can be addressed if we set up a systematic process to do so. But it's absolutely urgent because, as you say, we're losing companies who are going overseas.
Okay, but the issue is here, not just local competitiveness, which obviously drives down prices, or it should, and therefore gives consumers a better outcome and keeps inflation in check. The real issue here is international competitiveness, and it seems as though in many areas Australia has lost that competitiveness, be it on tax, be it on industrial relations, be it on just basically the speed of execution. These things, and energy prices is the absolute key. These things are the common sort of, if you like, factors that these chief executives are talking to me about.
Absolutely, Ross, and the slow approvals process is a national embarrassment. Just to get anything done, it seems, in Australia, the approvals that you've got to go through at various levels of government just take an embarrassingly long period of time. I talk to companies and they tell me how long it takes in Australia, and then they tell me how long it takes to go elsewhere, and they're going elsewhere simply on the basis of that slow process. So totally agree with that. On energy prices, look, the best thing the government could do would be to get the East Coast gas prices down. That would help get electricity prices down. Australia has by far the highest domestic gas prices of any gas exporting country in the world, by far. So we need to get particularly the East Coast gas prices down. There's various ways that have been talked about to do that. It was an issue at the last election. It's absolutely doable. Indeed, the international companies operating here really understand that the high domestic prices here are unsustainable and damaging their right to operate export industries.
Which goes back to your original point, which is the lack of speed in executing and saying yes to projects. I'm thinking here Narrabri, Beetaloo. You've also got the big Barossa project as well. So all of these three projects could create gas for the East Coast, which right now they're all in one way, shape or form held up. And as a result of that, energy prices are much higher than they should be, driving manufacturers either out of the country or out of business.
Absolutely, Ross. Look, whether it's an approval or a rejection, just do it quickly. That's the point. I mean, we're not saying wave everything through. We're just saying do it efficiently. If you're going to approve it, get it done. If you're going to knock it back, get it done. Narrabri, I think, has been going for almost 15 years through the regulatory approval process. I mean, that is just dreadful by any standard. So get it done one way or another. I mean, had Narrabri been told in 2012-13 that the answer was no, Santos probably would have gone on and done a whole range of other things. So it's just speed it up, get it efficient, and that if that means better legislation, if that means more resourcing of the people who provide the approvals, but that's what needs to happen.
So you were sitting inside the room this week listening to all of the suggestions and maybe some of the resolutions that might come. My great concern about it is we know what the problems are. The question is, what are the answers and how quickly can those answers come along from a political point of view? What was your sense about the need for the urgency for the solutions to what we identify as the problems?
Well, that's a good point, Ross. I think you have to acknowledge that just having the roundtable itself has built up pressure for answers, and so that's good. When I was in the room, there seemed to be a fair bit of consensus, so that's good. There was consensus about dealing with a lot of these regulatory issues. You know, you've got different employment standards, licensing standards across states. You've got different product standards, different procurement standards. You've got slow approval processes. You've got regulations that just shouldn't be there. But the way to deal with it, Ross, in my strong view, is you need a process to deal with it. Trying to put caps on regulations, trying to deem that you're going to approve something at a certain time. No, let's go through and fix the problems. And we've got the mechanism in place. There's the Commonwealth and state territories are coming up with a National Competition Policy Mark II. And you and I can remember in the mid-90s, that National Competition Policy had a good process around it, and it had a really good spring clean of a lot of regulations that were stopping competition. Now we need that spring clean of regulations that are affecting competition and productivity. And that mechanism is there. I think Commonwealth and state treasuries getting to work on it, getting it turbocharged. There needs to be money to reward states for changing things so that we get the incentive mechanism we had 25, 30 years ago. It can work reasonably quickly, Ross, if you staff it up appropriately and get it going. But top-down desire for change won't go anywhere. You need the Commonwealth and state treasury people working together methodically to go through these things. Yes, they can be given some priority targets, and the slow approvals process has to be number one. But there's a range of things I think they can do quickly, and I think everybody in the room that I sat in would applaud that. So let's just get on and do it, but make sure you've got a process to drive it, Ross. It won't be top down. It's got to have people working on the mechanics of these regulations to get them changed, and having a clear objective, which is probably in this instance productivity.
So what frightens me, to be honest, is that we have a first world social welfare system. And it doesn't matter where you look, that is baked into the budget, it's expensive. It doesn't matter whether it's the NDIS, childcare, aged care, healthcare, all of these things. And they're important, they're good, but they're only successful if there is enough economic growth coming down the pipeline. In other words, that the economy is going well. Our economy is barely growing at 1%. The long-term average is at 3%. And so unless you get that economic reward coming down the pipeline, it's going to be very difficult in future to afford those first world social welfare systems that Australia has already built.
Oh, look, that's right. I mean, obviously, Ross, you can see the focus on the NDIS, and you've got to constrain that in to make that workable. But you're right, you need economic growth to fund these things. Keep in mind the National Competition Policy process in the mid-90s boosted growth, boosted productivity. So you've got the evidence there that sort of spring clean of the regulations actually brings huge benefits. And here we can see the problems writ large. We just need to get a process to get on and do it. And the faster that process is put in place, the faster we'll see the results, and I think the benefits will flow. And the benefits for growth, Ross, are very large.
So then, Rod Sims, do you come away from the roundtable this week confident? Do you come away hopeful? What's the emotion you have when you walked away from it this week?
Oh, look, hopeful, I think, Ross. A bit of confidence, because I think having the conference has done two things. It's raised community awareness of the problem, and look, to be blunt, it's put a bit of pressure on the government to now do something. And I think there are things they can do which, in the broad, will not have any political pushback. Of course, there'll be some regulations and some approval processes you're speeding up and fixing that some people won't like. But if you're doing it in the broad, if you've got a methodical process, it actually can happen. And we've done it before, Ross. We did it 30 years ago. It turbocharged productivity. Let's do it again. Let's get the resources in there. Let's get the financial incentives for the states. Because once you get the financial incentives for the states, things actually happen. And they can happen quickly, Ross. And I understand your need for urgency. The government has a need for urgency to show that they're on top of this problem. And look, as I say, trying to fix the gas prices really matters, because there's a lot of industries in Australia that depend on gas, and also it would be the biggest thing you could do to reduce electricity prices, because at the margin, it's high gas prices that are affecting electricity.
I'll tell you what, Rod Sims, it is always great to chat to you. Thanks so much for a loan of your brain today, and I'll chat to you again soon.
Thanks, Ross. Really appreciate the time.
Well, after the break, there was one concrete conclusion from this week's roundtable. Drivers of electric vehicles and hybrids will pay more tax in the future. When we come back, we speak with the boss of one of the EV companies, Scott Maynard from Polestar.
This program is brought to you by realestate.com.au. Keep moving with Australia's #1 address in property.
Have a look at this. Apparently down the road sold for 1.5.
I wonder what we get.
We could move back to the city for that.
This is great. Is north facing good?
Which way is it facing?
South facing. Oh, look at those timber floors.
How many properties we seeing this weekend?
You, the city.
What?
I never thought I'd see the day.
Yeah, well, that was before the grandkids.
Keep moving with realestate.com.au.
A mentor has the power to change someone's life.
Being a mentor is one of the most fulfilling things you can do.
In the large scale, it can probably save someone's life.
What a hotel.
Right? And only $370 a night on my favorite site.
What? You didn't check Trivago?
I got mine for $250. You have to check Trivago.
Oh yeah? Prove it.
On Trivago, you can compare hotel prices from multiple different sites.
Even your favorite one.
Yeah, see? Same hotel, $120 less.
You didn't check Trivago? I didn't check Trivago.
Check Trivago to compare prices and save up to 30%. Hotel, Trivago.
3 Trees. Australian-made sauces, pickles and spreads. Supporting Aussie farmers. Australian owned and operated since 1919. 3 Trees. Because things taste better in glass.
Do you have a soft spot for deliciously fluffy omelettes? Delightfully cheesy pizza? Is your sweet tooth tantalised at the thought of fabulous desserts like this? If you love delicious food but are short on time, you need the incredible new 5-Minute Clever Chef from Drew & Cole. The time-saving meal and snack maker that cooks homemade food in a flash. Simply fill, close and let the 5-Minute Clever Chef do the rest. The secret behind its ultra-fast cooking power is its special oval-shaped, double-sided non-stick cooking plates that heat your food on both sides at the same time, reducing cooking time and ensuring your quick meals are cooked evenly and perfectly. Just add your favourite ingredients and it effortlessly cooks all kinds of fresh, delicious omelettes in under 5 minutes. No flipping. No pans necessary. And it's not just a marvel for egg dishes either. Double down on delicious dishes like Nutella-filled pancakes. Treat yourself to speedy cheese toasties. Evenly cooked, crispy skinned salmon. Or an irresistible, melting mini pizza in minutes. It's more compact than a toaster and takes up hardly any space. It's also a breeze to clean. The versatile 5-Minute Clever Chef makes everyday meals, snacks and desserts fast and easy. Call Global Shop Direct or go online now to get the 5-Minute Clever Chef from Drew & Cole for this low price and check out our 5 easy monthly payments. Plus, if you order now, you'll also get the bonus digital recipe book. It's filled with healthy, budget-friendly bites and quick delights. The 5-Minute Clever Chef simplifies cooking. Just fill, close and cook. And it comes with Global Shop Direct's 30-day money-back guarantee. The 5-Minute Clever Chef is where fast meets fabulous food. Get yours now, plus get the bonus digital recipe book when you order from Global Shop Direct.
Great idea!
Global Shop Direct!
It's good to have your company here on Business Weekend. Well, let's go to one concrete solution that came out of this week's roundtable and also from the Productivity Commission and its recommendations. Road user charges. The current fuel excise rate is 51.6 cents per litre of fuel it's sold, so $15.7 billion in the previous financial year. But with electric cars and hybrids, fuel usage clearly is coming down, but roads still have to be funded somehow. Adrian Dwyer is a long-term campaigner for road user charges, and I spoke with him about it a couple of weeks ago.
Yeah, that's right. If you don't raise this from users through a fuel excise or a road user charge, then it has to come from some other tax or services have to be cut elsewhere. So, we can decide which school or hospital we don't want to invest in, or we can fix this problem.
There's also another issue. The sale of electric vehicles has slumped sharply in the past 12 months. With all this, Ed Boyd caught up with EV company Polestar's Australian CEO Scott Maynard at its Sydney headquarters.
Government stimulus to buy new cars seems to work. We've seen it applied to light commercial vehicles for 20 years, and that's led to a disproportionate number of, say, dual cab utes being sold in Australia. They now make up 3 of the top 5 selling cars for the first half of 2025. So yes, it is our expectation that a new vehicle emissions standard or efficiency standard would add to sales in Australia for sure.
And as these emissions targets become lower and lower over time, is that just going to encourage even more sales into the electric sector?
Well, it's going to do 2 things. It's going to encourage more sales into the sector, but more importantly, it's going to encourage manufacturers, OEMs and importers to bring that style of product to market, make it available for Australian drivers. These cars are cheaper to own. They're now in a really strong price competitive position, and so we'll see more activity from OEMs, and that's already started.
Yeah, you mentioned that some of the top selling vehicles are actually not very fuel efficient. They're utes, 4-wheel drives. There's also fringe benefit tax benefits as well for those sorts of cars. Does that need to change?
It's time for that to be overhauled. It's become disproportionate. We've got more than 1.5 times the number of utes registered to the number of tradespeople registered. These are no longer a tool of trade. These are not even being sold as a tool of trade. And it's been artificially incentivised. So it's high time we now change our objectives to look after environment. Now that there is a product that's comparable to that and is to the benefit of motorists.
Yeah, are you worrying about, are customers worrying about emissions though when they're buying your cars, or do they just want to buy an electric vehicle?
A little bit of both, which is nice. Now that electric vehicles are fun to drive and easy to own, we're finding that they're becoming more and more desirable in their own right. But there is a tangible shift in buyer sentiment to be looking for vehicles that are representing a lower CO2 footprint.
When are you expecting sales to kind of normalise?
We saw the introduction of a couple of new models late last year. That's serving us well. So we find ourselves 23% up on last year. This month is going particularly well for us. So we're now starting to see some really strong growth. And I guess the other thing that's satisfying for Polestar is that a lot of that early business was done through rental, rideshare, bulk fleet style business, which was fantastic to give customers experiences in our cars. We've now done the bulk of our business this year in retail, private buys, which is really a nice way to cement the brand.
And just talk about the retail trajectory you've been on over that last 3-year period.
So new car sales generally have slowed. This year we're down 1.5% on the same time last year. Electric vehicles went through a real burst of growth through that introductory phase. A lot of new adopters picking electric vehicles up. Electric vehicles are down so far this year. However, we're finding that the share of market taken by electric vehicles is slowly increasing. It's been increasing each month of 2025, and it's just under 8% at the moment.
You go back 5 years ago, it was all about wanting to buy a Tesla or owning a Tesla. What's the new, do you think, the aspirational brands that customers are looking for now? Because it seems like Tesla's falling down the list of desirable vehicles.
Yeah, there's probably a few reasons for that, but we're finding some of those traditional players which are introducing more and more electrified product to their range. That's taking up really well. We're seeing now a shift in premium buyers looking for a premium or sports style offering in electric vehicles, and as we cater to that market, that's increasing sharply.
And you look at global tariffs on cars at the moment going into America. We've just seen Japan have cut a deal with the US. That's pushed up the share prices of the likes of Mazda and Toyota. I mean, what sort of impacts are you expecting on the global scene for tariffs in the United States? Is that going to have much of an impact for Polestar?
It's had an impact on Polestar's performance locally in the US. Polestar has already moved to set up production facilities in lots of different markets now. The new Polestar 7, it's still a little way off, has been announced to be built in Europe. Polestar 4 is about to switch to a production facility in Korea, and so there's now a global footprint of production facilities that Polestar can draw on. They're operating in South Carolina in the US, and that allows them to ensure that they maximise the sell price that they can deliver in each market.
And it's obviously a bit early to say, but the second-hand market for Polestars, is that going to become a thing in the next 5 or so years, customers reselling their vehicles?
As we see customer confidence in electric vehicles grow, and as we see more and more studies released that show that battery degradation is actually better than it was first tested. Stanford University just recently released a study that suggested that battery degradation on these vehicles could mean that they actually last 40% longer than originally mapped out. As that sort of confidence permeates through the used car market, we're seeing residual values improve, percentage of loss on vehicles improve, and as the demand for the vehicle increases, we're seeing that improve as well. So we're already seeing quite a healthy scene for used car sales, particularly in the Polestar band and in premium vehicles. We don't expect that to change dramatically or continue to improve.
Yeah, because it seems like there was a risk in the past of buying an electric car that had been on the road for 10 years and you weren't sure what sort of range you were going to get out of the car.
So many myths that crept into those early transitionary trading periods for electric vehicles, and now that we're overcoming some of those things like charge times, like range anxiety, like battery degradation and lifetime of battery, we put an 8-year warranty on our batteries. And so the assumption is that that's how long they'll last. We don't see petrol engines being replaced after a 5-year warranty is exhausted, and it's the same with batteries, and that confidence is now starting to grow as we bust some of those myths.
Scott Maynard, Managing Director, Polestar Australia. Thanks for your time.
Thank you, Ed.
So that's it for the program this Sunday. Up next, all the latest news right here on Sky News. Business Weekend returns next Sunday, but of course you can keep up to date with the latest business news with our daily program, Business Now, 4:30 p.m. Eastern Time, and via our website, skynews.com.au. Thanks for your company today. I'm Ross Greenwood. We'll see you next week.